Hey, welcome back to the channel. In today's video we're doing a simplistic stock analysis on BYND Stock as requested by several subscribers in the last BYND video. But before we get into today's video, I want to thank you all for the incredible support on the last one. Over 500 views and almost 40 likes in the first 24 hours. Hopefully we can get a similar response on today's video. If you do enjoy it, make sure to like. If you're new to the channel, make sure to subscribe and turn on notifications, as that is by far the best way to support the channel. Beyond Meat is valued at around $10 billion, but only had a revenue of $300 million in 2019. Why is its price to sales ratio so high? We're going to examine that in today's video, and we're going to go through why Beyond Meat is potentially a $50 billion company in the future. One of the great misnomers of investing analysis is the tendency to avoid context, and I think it's very important, particularly with growth companies like Beyond Meat. Beyond Meat's IPO was $75 and it went as high as $234.90. As you can see at the beginning of this graph, the first third of the graph. But then it crashed. But people seem to think, oh, its all-time high was 234 just a few years ago, therefore it can do it again. And a lot of beginning investors tend to do that. They just buy stocks hoping that it will reach its all-time high because it's done it before. And most stocks tend to trend upwards over time, and that's the reason they buy growth companies. But we actually need to put it into context that Beyond Meat took a heavy dip from its all-time high down to the low 50s, and that needs to be put into context because many people will just buy, as I said, seeing that's at $166 currently, and just assume that it's going to recover to that 234 sometime in the future, particularly after the virus situation is long and gone. So that's very important to take a stock and put it into context. Let's take a look at Beyond Meat's revenue. So in 2017 it was $33 million, 2018 was $88 million, and in 2019 it was $298 million. This is rapid growth in a very short period of time, and Beyond Meat's revenue has grown by triple-digit percentages every single year. In the first quarter of 2020, they managed to achieve $97 million in quarterly revenue, a 141% increase year over year. That means they made almost 2.5 times the revenue in Q1 of 2020 than they did in Q1 of 2019, with some severe global economic headwinds. The stock looks very cheap if you can assume that it's going to continue a 50% compounded annual growth rate in that revenue, as it's been doing triple digits over the past few years. And that's why people continue to pour money into this stock. It's currently valued at around $162 per share, giving it a market cap of around $10 billion. Its all-time high was when the stock traded at $234.90 on July 26th of 2019, which gives potential upside for the stock in the long term. And most people are going to continue to buy it because they do believe it will surpass that in the future if it can continue its growth rate. Let's take a look at Beyond Meat's financial report for Q1 of 2020, which you can find on their website. I'll leave a link in the description below to their investor relations page. Beyond Meat's cash and cash equivalents balance stood at $246 million and total outstanding debt was $30.6 million. So they're in a great place in terms of cash to debt ratio. Their debt is quite low and their cash is in a solid position and has been for a while. And I'm assuming that they will raise more over the next 12 months as interest rates are near record lows. We're seeing almost negative interest rates in the US, so it makes no sense to not raise more capital. Capital expenditures totaled $12.4 million compared with $3.8 million the prior year. This increase in capital expenditures was primarily driven by growth according to the company. So they're continuing to invest in expansion as they should, because they're starting to pick up more partnerships and deals, and they need to expand into global markets because they've focused domestically and have now decided to go into China with Starbucks. They're in KFC and Dunkin' Donuts domestically, and they will continue to expand into other areas in the world because there's no point staying domestically once they've built up the brand name that they have. They're the leaders in the industry, and I think they're going to continue to rapidly expand into several new markets, including mainland Europe. Current ratio measures a company's ability to pay off short-term obligations, so in layman's terms it's just a ratio between current assets and current liabilities. Ideally you want this to be as high as possible, and Beyond Meat's is 5.78, which is very high compared to the industry average. This is essentially, can Beyond Meat pay back short-term obligations, which it obviously can with a 5.78 ratio of current assets to current liabilities. This is a very optimistic sign for investors and very positive, as you know you're investing in a company that can pay off its obligations if a global financial crisis was to arise, which what we're currently going through at the moment. This is probably a good time to assess a company's current ratio and compare it with the sector average or even the sector median if it is a fast growing company. I think most investors make a huge mistake of not using the economy and incorporating economics into their investing decisions. They do it purely off of mathematical basis, or they just look at financials of an individual company. But I think understand where we are in the business cycle, are interest rates low compared to the last few years, and is the overall economy over leveraged? Because if interest rates are low, you can borrow cheaper and expand at quicker rates, and that needs to be incorporated into your investing decisions. The debt to equity ratio basically measures a financial leverage of a company. The lower the better, obviously you want low debt, and Beyond Meat's debt to equity ratio is 0.04, which is very reassuring for investors to know they're not drowning in debt. They actually have very, very low debt, and they can continue to invest in their rapidly expanding business model.
So I think the main thing when we look at how to recreate animal protein is to focus on the texture, because you can flavor animal protein or meat in so many different ways, but if you don't have the texture right, you have no canvas to work with. And so we have been really maniacal about making sure that that fibrous structure is there. And then ultimately, as we scale the process, that the price is competitive with animal protein. There's nothing that can stop us from a material basis or from a labor perspective from dramatically underpricing meat as we grow in scale.
I think Beyond Meat stock is personally too expensive for me at the current moment, but if we do see below 150, it could be a good time to add to our portfolio. Hopefully you guys did enjoy today's video. If you did, as I said, make sure to like, subscribe, and leave a comment down below on any other stock you want to see in the future. But thank you all for your support, and I'll see you guys very soon for another video on the channel.